Hello and welcome to this YouTube channel for ACCA FR exam prep. My name is Adam. In this video, I will be taking you through how to account for a non-current asset held for sale, which is under IFRS 5. Now, let's look at the question. Starting with the requirement. At what amount should a property be reported in Don's statement of financial position as at 30th September 2014? As I've always indicated, you need to know the dates, the reporting date, transaction date, and so on. Now, here we have an extract from the financial position of Don's as at 30th September 2013. And if you reconcile these to the current year end, it means that this was the previous year. It means the year would start 1st October 2013. Very important to have this understanding as we solve the questions. Now, we have a property at cost with a useful life of 15. The value was 45 million. And we have accumulated depreciation of 6 million. And what it means is that at 1st October 2013, the carrying amount of these assets should be 45 minus 6. And that should be, this is 39. That should be 39 million. Very important. Now, on 1st April 2014, Dan decided to sell the property. So what it means is that there is a change in the use or the intention for holding the asset. So on 1st April 2014, and quickly, you have to also reconcile this to the start of the year. So from 1st October 2013 to 1st April 2014, that will be 6 months because we have October, November, December, January, February, March. So on the 1st of April, this will be 6 months. So we have 6 months to 1st April 2014. Very important. So it means that as we begin to account for these assets held for sale, we need to find the carrying amount of this asset as at the date of 1st April 2014. The property is being marketed by a property agent at a price of 42 million, which was considered reasonably achievable price at that date. The expected cost to sell have been agreed at 1 million. Recent market transactions suggest that the actual selling prices achieved for this type of property in the current market condition are 10% less than the price. So it means that the reasonable price will now be 90% of the original intended price to sell the asset. At 30th September 2014, the property has not been sold. Now, we need to look at the recognition criteria under IFRS 5. It says that the asset must be available for immediate sale in its present condition, and that the sale should be highly probable. The sale should be highly probable. Now, what makes a sale highly probable? One, there should be commitment by management to sell. That is to say, there should be a detailed plan in place to sell the asset, and that the asset should be marketed for sale at a reasonable price. And what it means is that they should be looking for a buyer. They need not find a buyer at the reporting date. And that from the date of the asset being held for sale, the entity have 12 months within which to sell the asset. So by the reporting date of 30th September 2014, it is only 6 months from the date of holding the asset for sale, and the date of holding the asset for sale was 1st April 2014. So they are still within the 12 months. So it means that all the criteria for recognition as held for sale has been met. So therefore, we have to account for it. Now, how do we measure the measurement? The measurement for an asset held for sale. Now, the standard says that it should be measured at the lower of the assets carrying amount at the reporting date and compared to the asset net realizable value at the reporting date. Now, let's look at the measurement. So what it is that I need to find the carrying amount. So I'll say carrying amount at 1st April. I need to establish that. And that would be carrying amount at 1st October 2013, which was 45 minus 6. Let's say that gives us 39 million. Then we need depreciation for 6 months. And because the property is depreciated over 15 years at the cost of 45, now the depreciation would be 45 divided by 15. That should give us 3 million per annum. And because we are looking at from from 1st October 2013 to 1st April 2014, which is 6 months, we need to look at 6 over 12 of the depreciation. And half of 3, that should be 1.5. So it means that the carrying amount, at the first of its asset is 39 minus 1.5, and that should be 37.5. Now, the other point to look at is to determine the net realizable value at the net realizable value will be the selling price. Earlier, the selling price we were told was 42 million, but at the year end, they can only achieve 90% of that. So that will be 42 million times 90%, that is 0.9. So 42 times 0.9, that is 37.8. And the net realizable value should be less cost to sell. And the cost to sell here, we're told that agents often charge a cost of 1 million. So we have to less the 1 million from this. And this should give us 36.8 million. Now, in determining the lower of these two figures, so this is the carrying amount. So comparing the carrying amount and the net realizable value, the net realizable value is the lower. So therefore, at the year end, the assets will be stated at the net realizable value. So from these options, the net realizable value is 36.8. So if you're not careful, you are likely to choose the B option, which is 37.5, and that should be the carrying amount. And because it's lower, we take the net realizable value. So this is how we account for a non-current asset held for sale. First, you always have to remember that from the date the asset is held for sale, no depreciation. So it means that carrying amount at 30th September 2014 will still be the same as the 37.5. The criteria held for sale has been met. The asset is not depreciated. I hope this helps you in your preparation for the exam. Please subscribe to this channel to receive updates on new videos.